this is one panel that applies to everyone, regardless of if you're in the finance industry, if you're not from the finance industry. This is one topic which applies to all. Anyone who missed it, I'll just explain what this FIRE thing means. So FIRE stands for Financial Independence and Retire Early. Basically, the concept is that when you're young, you save as much of your salary as possible, and then you retire early, and then they will tell me what they do after they retire. So we can just begin by talking about what FIRE means to each one of you. So I'll give you one minute each. So Manish, can we start with you?
Sure. I think FIRE is obviously about being smart enough to manage your money and make it grow to meet your goals. So Warren Buffett had this saying that if you don't let money make itself while you're sleeping, you will have to work until you die. So I think that's the point, that I think a lot of us spend so much time creating or earning money, but we manage it atrociously, right? Because I see in a lot of my relatives and friends that people will argue with a maidservant, argue with the driver about 20 rupees, 50 rupees, but they will leave 5 lakhs lying in the saving account. So I think it's so simple that if you allocate your money in a reasonable, efficient manner, you can avoid a lot of negative experiences in life, but people somehow don't do it. So to me, FIRE is just about being a bit aware of where your money should be, a bit of optimization about getting right returns so that your life is simple and pleasant.
Interesting. So FIRE is about keeping the right allocation so that your money is efficiently used. Vishal, you do this for a living. In the sense, people come to you day in and day out, and they ask you for advice on retirement, how to manage their finances. So in short, what's the definition of FIRE for you?
So I think the question I asked them is, do you want normal FIRE? Do you want fat FIRE? Do you want lean FIRE? Do you want coast FIRE? Now they are like, oh, ye kya hai? Because the FIRE that they know of is either they're firing their children, they're firing their parents, or they're getting fired themselves by their you-know-who. So I think the starting point has to be really what is FIRE for you. And I think it's very, very important to define it for yourself. So I'm just going to give you a little bit of a theoretical framework in terms of making these more relevant. So when you think about FIRE and visualize, let's say this retirement, right? You've retired early. Now what does it mean for you? For some people, it means that they can do all the things that they couldn't do. Many of those things will come with spending more money. Let's say travel the world. Or raising the standard of their living because they never got time to spend their money. So those are those fat FIRE category of people. Then you could have lean FIRE. People who are saying, you know what, I'll cut my expenses so much that I can retire early. That's another type. There's a coast FIRE or a barista FIRE. What does that do? It actually tells you that I'll just earn enough or save enough and invest enough so that my basic expenses are taken care of. And then I'll live a slightly simpler life. So I can choose what I want to work in. Maybe I want to work part-time. Maybe I want to do something else. So I think the starting point, for me, I'm a fat FIRE kind of guy. Okay? But everyone has to define their own FIRE. And that's what we tell investors.
Vishal, generally, what kind of FIRE are people looking, your clients?
So I think it changes. Interestingly, FIRE morphs as life stages happen. I think they start off with fat FIRE, and then as they age, many of them move towards lean FIRE, saying, "Ye sab moh maya hai."
Interesting. So another interesting fact: we have two panelists in this panel who has actually done this FIRE thing. So they have achieved FIRE. They are Naveen and Samit. Coincidentally, the topic is financial independence and retire early. Some people in the backstage told they don't look exactly young. But anyways, Naveen, what's the definition of FIRE for you? Sorry for that. My roommate said that to me, and that was not my dialogue.
I don't think there's anyone here looking older than I. So I'm fine with it. See, we are in a country that does not have social security. The most miserable thing in any society would be to see old people unable to look after themselves, people on the street, and that is a commentary on society. Financial independence, therefore, has to be something that maintains a person's lifestyle in a reasonable manner till their death. That's all it means to me. And of course, when I talk of this, it's family as well. Our spouse cannot be abandoned on retirement.
Next, Samit.
Thank you, Sachin. So for me, I didn't know all of those definitions, by the way, Vishal. So some of those are revelations for me as well. For me, it's like there's a phase in life and career when you work for money, but you have to draw a line and say, now money has to work for me. And that's when you have to follow a few things which you couldn't do in the first half of your career. So I'm enjoying this phase of life where I've taken an early retirement. I may not look as young, but I can say the firm that I quit, I could have worked for another 15 years. So I think it's an early retirement, but enjoying every moment of it.
Many people have tried to figure out Samit's previous drawn salary, but he has been hiding that
Gone.
forever.
Yeah, I mean, that's an incorrect anchor bias, because my view is if I tell a number, then people start doing calculations and then it goes haywire. Each one. So the other thing about FIRE or in general about financial independence is everyone's number is different. You know, with due respect to all the formulas, they are a guiding tool for you. It's like a compass which tells you which way is north. But specifically, each one's would be a hugely different number. And therefore, if I say my number is X, it may not, it should not excite you or demotivate you. So that's the reason I don't want to share a specific number. But what I can tell you, Sachin, is based on my current expenses, I'm at 60x. So thankfully, when I saw Ravi Saraugi's presentation, I know I'm in a safe zone. So far, so good. But you never know what comes tomorrow.
So Vivek, before coming to you, I just wanted to give some context. So a lot of people, when they go for financial advice, they go through the online mode, especially the young people. And you have this financial platform which advises people in the online format. So it would be very interesting to know what people are looking at, and obviously your definition of FIRE. And if you could share a little bit on what people are looking in the online format.
Yeah. So before I start, I think barring today's market rise, I'm sure if the market had fallen for a few more sessions, a lot of this fire would have been extinguished. Because a lot of this fire has been fueled by the market rise. One big problem that I see is that people are extrapolating last 2-3 year returns and calculating their fire number, which is extremely hazardous. And that's why I actually mean it, that a lot of fire would actually have been extinguished if the markets fall or stays depressed for another few weeks or months. That is one. Second thing, on our platform, what we see very surprisingly, 77-78% of the retirement goal is unachievable by people. So what they do is they give priority to a lot of goals like cars, homes, kids' education, and retirement is unfortunately a very low priority. And this is something which I speak not on hearsay about actual numbers on our platform. Approximately 7,000-8,000 sample size. So that is the second. Third is in terms of what FIRE means to me. For me, FIRE means, personally to be able to enjoy freedom of what I can do, having freedom over my daily schedule, and lastly, not being able to think twice about giving my family the best education or medical requirements. And yeah, that's what it means to me.
Thank you so much. So next, Naveen, I'll head straight to you. So you have an extraordinary story. Some of you must have read Naveen's story in our paper. So Naveen has worked all his life somewhere or the other in the finance industry. He has served for a very long time in the mutual fund industry. Unfortunately, at the age of 62, he discovered he had last stage cancer. And he has a fantastic story of how he's planning his finances for whatever eventuality comes. So Naveen, over to you, and you can take your time, and we would love to know what your journey has been.
Thank you. Just a quick A very quick survey. How many of you own or your family owns a residential property, whether you're living in it or it's in your hometown or something? How many do not have one? Just so few. Thank you, sir. Thank you, ma'am. How many of those who own a property believe that a financial asset is superior to a real estate asset? Quite a few, right? And why on earth do you have, or me too, why on earth, you're the exception, sir, thank you, have a real estate asset? I tell you, for me, it keeps my wife happy. Really. She has the comfort of a roof above her head, which is a constant. Large part of my retirement income, and when I decided to retire, that was about 9 years ago, I was 53. I decided to do what I enjoy, and by that time it was teaching. I've enjoyed teaching for several years now. And I found that my fixed income, and for me, now FIRE is no longer financial independence, but it is fixed income for retirement. This gives me the comfort. Equity goes up and down. Vivek did say that the market's a little up today. If it wasn't, all our bullishness would have gone. But even if you look at long term, people talk about equity being great. For me, it does not matter. I'm willing to sacrifice something. I've been a portfolio manager. I've been in mutual funds. I'm an equity person since 1982 when I invested 125 rupees in equities. But today, 80% of my portfolio is in the fixed income, earning around 12%. And this gives me the cash flows to be able to sleep well at night. My wife sleeps well, except when the dog keeps rolling around. He likes to sleep with me. So fixed income to me is that magic that gives me peace and cash flows. One small thing, most of us are finance people here. When you calculate returns, your interest calculations are always back-ended. That is on your calculator or Excel, you use end mode. Except for retirement and annuities. There you use the begin mode, which means interest is most important. We seem to forget that sometimes. So I have built up I've doubled my corpus, retirement corpus in the last 10 years. I do not see a risk because of very careful selection of my bonds. We had Saurav Mukherjee earlier today, and a few weeks ago he picked up a few stocks including MAS Financial. Last few years I've picked up bonds of MAS Financial. I think I'm making more money than he will. It's an opinion, okay? But by studying the equity of that stock, I'm finding the comfort, the financial ratios that give me a sound, safe, and very comforting investment. And that's my research, and that's where my money goes.
So, Naveen, before we let you stop on that, a lot of us have been talking in very finance terms. We get 10% return, 12% return. But after all, finance is also very personal. So, if you don't mind, Naveen, could you share, how many people in the family are earning? What's your daughter doing? How much is your monthly savings? And how much money of it is coming from the interest itself? And do you have anything for the wealth part? So just wanted to combine whatever you have from the finance part with the very personal family member kind of a situation.
Our daughter is in Paris. She did a post-graduation in France and she's studying there. She's financially independent. She has, because of a very, very stingy father, a habit of saving, overspending. Wife and I live on interest income and a few other things. I do some ghost writing, teaching and all of this, earns a little bit of money. We also have taken and we fostered 2 girls who've been displaced in the Manipur disturbances over a year ago, and we educate them. And they will have, to the extent that they can earn it, the same education that our eldest girl got. All this is funded by our investment income and the other income that I mentioned, rent from a 1-bedroom apartment that we own. It also allows us to redeploy surpluses. So inflation is not going to be, I hope, damaging to us. So we get about 12% returns on our bond portfolio. After tax, it's about 9%. And we live a comfortable life on that, educating 2 girls. Our daughter also uses her surpluses. She's very good at music. And her entire music income goes towards educating children.
Thank you so much, Naveen, for that wonderful story. So, Samit, now I'll come to you. FIRE involves basically 3 steps. First is when you're working, you have to make sure you're earning a sufficient amount of money, and then you need to save a big chunk of it. Draft the plan. Second is draft the plan where you invest it in assets which will yield you good returns, and then you have a corpus. And the third is the withdrawal phase, where after you retire, you withdraw the money. Could you please share how this 3-step journey was for you in your case?
So I never seriously thought of FIRE till I was age of around 40, 41. And thankfully, Naveen didn't ask this question 10 years back, because at that point of time, till the age of 40, I think I was only looking at buying an apartment every city that I had worked in. So I had ended up with 4 apartments. And I used to think, wow, I have 12 bedrooms and 11 bathrooms across the country. That was the kind of logic I used to keep myself happy. One day I sat down with all the calculations, and these are properties brought over multiple years, right? So different time, different city, all the equations were showing me that in 3 out of those 4, I was losing money as compared to if I would have invested in, let's say, stock market, mutual funds, etc. And including the fact that I looked at rentals and tax benefits, blah, blah, so whole detailed maths. And that's when I said, I need to now seriously think about money. So around the age of 40 is when I really started looking at how to save more and invest judiciously. And by 50 is when I was ready. Actually, I was ready by 47, but then COVID came. Obviously, it gave a shock. I still could have taken early retirement, but I said, let's see this through. So then I finally quit in 2023. So that's the journey of savings now. I have a mixed portfolio, very heavy on mutual funds. I dabble a bit in direct stocks as well. And out of sheer diversification, I've given a chunk to someone as a PMS, a small chunk. That's the whole. So if you were to look at it, is it financial assets? 99% of it is financial assets. Within that, it is a mix of debt and equity. It is between PMS and mutual funds and direct. So that's how I have tried to diversify. I have my own one house, so I don't need to depend on, taking something on rent. In fact, with the surplus that I had, I built a farmhouse also nearby Bangalore, so we enjoy that time as well. But those things are ancillary or secondary, not a primary focus for life, right? I would say at this stage now, it's a decision that I take every quarter to say, where should I fund for my next quarter? I have a very clear visibility of how much I will need. My son's just joined engineering college, so I know.
So on a quarterly basis, you decide where you will be spending.
Yeah, if the market is doing great and, you need to take the cream out of that milk once in a while. So I will, withdraw some money from my investments, right? Or else if I know this is not a right time to withdraw money from equity, then I do have. So I have a ladder approach even in debt to say some is liquid, some is in short to mid term, some is long term and gilt. So I have spread it all across. Then I take that call every quarter to say where do I withdraw that money.
Interesting. And this is not to scare the two of you, but the third question is how can fire go wrong? How can the fire misfire? So
I will take that up before Naveen does. It can go horribly wrong. First of all, fire, the numbers out there are all assumptions, right? It's a function of how much are you spending, how much will you spend, how much you're earning, how much you're going to save, how much are you going to, what returns you will get, what will be the tax rates. None of them is locked down. None of them is locked down. So therefore, if anybody just simply looks at, and therefore that's where I say it's to a large extent personalized, that you have to sit down, talk to a person for at least 2 to 3 hours before you really understand what will work for that person. If somebody just says, here's a digital calculator, key in your 11 different assumptions and you will get a number, it is a guidance, but definitely not going to take you there completely, right? So a lot of those assumptions can go wrong. And this is all, let me tell you, fire is not just a financial consideration. That's another thing which is very less spoken about. And I can tell you from my experience, it's also about social and mental considerations, psychological considerations. Forget anybody else within the family, parents, kid, spouse, they will question, what? You want to retire early? What are you doing with life? Right? There'll be so much of pressure. Society will question you on all of that, right? So there are those elements that need to be factored in. And suddenly there was a time when I was not returning my friends' calls for weeks because I was busy. Suddenly I am free, but now they are busy. So don't expect that you will go and suddenly one fine day sit with friends and say, come on, let's have a beer today evening, because they'll be busy. So suddenly life will bring in changes. Be ready for that. It will not all be the same thing, but you need to decide whether you want to do things that you've not done earlier in your career. I mean, I love to read, so a lot of my time goes in reading. I love to do that. And I spend some time at my farm, so I'm a very poor farmer. And believe me, my respect for farmers has gone 100 times more. Growing vegetables on a small piece of land itself tells you how difficult that life is. Right? So I'm learning new things and I'm enjoying that part. Now I'm also doing some training sessions and all of that. That keeps me happy. So primary focus now is not earning money. If it comes, great. If it doesn't change me or my life. But I'm enjoying this time, this moment. Maybe because I'm an introvert, I can be happy being alone for days without having to talk to anyone. So that works for me.
yeah, it's excellent that you're not bored with the retirement. So hats off. Yeah. Manish, a lot of people would be, having this question. Markets can crash anytime. So let's say I want to retire tomorrow, and I see a situation like the 2008 crisis where the market drops. So what should people do? How should one plan for it beforehand?
So as they say, the only free lunch in investment is diversification. I think people should be aware that equities is a risk asset. Fortunately for us, we live in India where economic growth is high, and therefore we've not seen very long phases where equities has hurt. But when you look at the examples in a lot of countries like Japan, where for 20, 30 years equities did not produce any positive return, I think we should be conscious that what has worked in last 20 years, there is a small risk it may not work. So I think it's very, very important that we have a very disciplined asset allocation. I think a lot of discussion here pointed out that all our plans has to be customized. It has to build in a lot of margin of safety, because obviously retirement is such a big decision. In one sense, it's an irreversible decision. You can't change too much after a few years of retirement. So I think the portfolio has to be very, very resilient. While I love equities, I generally think Indians have underinvested in equities and overinvested in real estate. But having said that, should it be a big proportion of someone retiring? That may not be true, because as I said, the equity cycles, and again, as as it was pointed out, I think the risk today is that people who've seen equities for last 5, 10, 15 years, they've not really seen a very extended period of low returns. So we started investing in mid-90s. And if you go back to that phase of 2000 to 2003, where stock markets hardly used to move, even the blue chips used to move 2-3% in a year. It was a very dry period. I think a lot of people have not seen 3-5 years of dreary markets, very boring markets. And history rhymes, so we might see that coming back. So I think when people make the retirement plans, it is very necessary to look at other countries, what has happened, look at even India, maybe go back more than 15 years. Markets used to be much more choppy. There used to be very long periods of time where return was zero. And I think for all we know, those phases may come back. So we should factor all that in retirement, I think.
Yeah, FIRE stands for Financial Independent Retire Early. Only the acronym sounds easy, but in reality, we are figuring out how difficult it is. Vishal, we are running a little short on time. Can you please quickly tell us how FIRE can go wrong?
So many ways. I think the few things that we've seen often go wrong is how a health incident can completely change fortunes. And this may be in spite of having health insurance coverage. A very long hospitalization, pre-existing conditions which were not declared. I mean, a lot of those things mean that even your health insurance that you thought was your sort of safety net does not work. So that's one thing that we come across very commonly. The second thing is the inability for people to manage their time. And Samit spoke about it when he mentioned, I'm an introvert, right? I think the challenge with having extra time is that, very often you spend money to deal with extra time that you have. And therefore, what you end up doing is you end up traveling much more. You end up in your brain telling yourself that I deserve this. I have worked for 30 years. And, I have slogged morning to night, blood, sweat, tears, all of that. I mean, the whole jargon goes on in our brain, right? And you end up, therefore, consistently overspending. And you keep saying that it's only this one time. The third thing that happens is that you always tell yourself that, my kids are independent. They will fund their own post-graduation. And then your kid gets a great admission, but he doesn't get a scholarship. And now you're at this point of thinking, saying, now what do I do? It's my retirement, and it's a great post-graduation. How do I solve this problem? And Papa and Mummy will not agree on this. So what will then happen is that you will end up taking out money from your retirement corpus and putting it inside there. So I think there are lots of things that happen in the real world. Assumptions, of course, are, many, many problems. But I also think life expectancy gets grossly underestimated. There are just too many people who live significantly longer than what data shows us. And the last many years of their life could come with very high cost for taking care of them. And many of these things are not necessarily modeled in the way that retirement planning, especially in the withdrawal phase, works. These are some things that we come across.
Interesting. In other words, Vishal is trying to say, if you get retired, don't go to the bar at 11:30 a.m. So lastly, could you please tell us in brief how the FIRE can go wrong? Same question to you.
I think most of the points have been covered by Vishal and Samit. I think one thing mathematically, what we recommend people is to, there's a concept called lifestyle creep, which is essentially what it signifies is that your lifestyle keeps creeping up as your income grows up. Unfortunately, once you retire, that creep still continues. And hence, when we plan for retirement, we consider a certain inflation number, which is actually understated. So what we typically recommend individuals is to take maybe a couple of percentage points higher in terms of inflation number to cope up with that lifestyle creep. Of course, the other things, which is rightly mentioned, is medical insurance, extrapolation of past returns on equities. Third thing, which I think has not been mentioned, is liquidity. I think a lot of people misjudge liquidity requirements, especially during retirement. It is very important to have at least not 6 months, as people say, 12 months of liquidity with you to meet any unforeseen lifestyle expenses, because whether it's equities, even fixed income at times, there could be delays, etc. So very important to have liquidity. In my mind, liquidity is one extremely understated facet of one's financial planning. So I think these are the two things, liquidity and lifestyle creep, which people should keep in mind, apart from medical and taking care of your mind. Empty mind is the devil's workshop. So yeah, I think that's about it.
That's a very good point. Once you retire, you can't increase your lifestyle at a very rapid pace also. So with that, we can take a few questions. If you have any question, you can direct it to any of the panelists. Or if you want, you can share your own personal, FIRE journey. I think we have someone in the back.
Hi, Naveen. Question to you. My name is Vishal Arora. I'm very intrigued by your statement when you mentioned about 12% returns from bonds. Very keen to know which type of bonds these are, because I haven't heard of 12% returns from bonds. And the other thing you mentioned also about the fact that you doubled the money over 10 years, which would mean about 7% returns per annum. So would you please elaborate on that?
All right, let me take the second part first. I've doubled my corpus because I was also working. Though I've retired, I was earning from teaching, rent, ghostwriting, corporate training. Though I was doing it at my own pace, because of a budget, we are very clear about how much is the minimum of our income we put back into investments. And that has given a return, that has doubled our corpus over the last 10 years. The second thing is your question about 12%. Over the last 1 month, I've invested in 2 bonds that give more than 12%. I mentioned Mass Financial. I think the financials of that company are pretty good. I'm sorry to be using an example, but I study the financials, capital adequacy ratio. I love a company that has raised a lot of equity at a very high premium, and I'm holding the bond because I'm safer. I like low dividend payouts. I'm not in equity. I want them to build up the reserves so that my money as a bondholder is safe. And all this, I've bought bank bonds, IndusInd Bank, Karur Vysya Bank, South Indian Bank at 13.5%. All of these over the last several years, currently it's at 12%. There are bonds that give you 16%. I do not touch them because they're high risk. But I'm very comfortable with the very low perceived risk, in my opinion. That gives me about 12% taxable with a regular cash flow. 12% taxable is about 9% tax-free.
So again, follow-up question on that. A company which is so well capitalized, has enough equity and good ratios, why would that company be giving 12% interest on bonds?
Okay. I do not look at the credit rating, though I like to stay in the A category. The global financial crisis of 2008 was when AAA bonds defaulted globally. Okay, so I do not have any respect for a credit rating agency, but I have a lot of respect for my personal efforts in research. So I go painstakingly through the financials. One. Secondly, it takes time for someone to build up a credit score, therefore a credit rating. If you saw the Mint about 2 or 3 weeks ago, it mentioned that exporters are paying more than 12% for their borrowings. Not a few years ago, there was a preferential rate and exporters were getting the money at 3%. If an exporter has to pay 12%, I think anyone else has to pay 14, 15. It's not an unreasonable rate, sir. In fact, my activity in bonds started with a colleague of mine, a very senior professor, who said, "Hey, what is this financial planning you guys do?" I said, large part for me and for someone like you who is in your 60s is to buy bonds. He says, my salary account is at South Indian Bank. The salary goes there. Whatever surplus, I keep in a fixed deposit there. I said, yeah, you're getting 6.5%. The same bank, I have a bond which gives me 13.5%. He said, what about the risk? I said, but what about your risk? You think your fixed deposit in South Indian Bank is risk-free and my bond in South Indian Bank is risk-free? It is finding those sweet spots that gives you those returns.
Thank you. Thank you very much.
That's a Naveen is an expert. He teaches bond. He was teaching bond until recently. But for the last question, we want to take something which is not bonds related. So if anyone has a different question, I think we'll take last two. So after him, you. And then, yeah.
Hello. Yeah. Good evening, sir. My name is Dr. Samit Vyas. And about 10, 12 years back, me and my wife, she's also a doctor, and we decided to go for the fire. And we have achieved our goal and collected more money than what we had set as a target. My question is, I am ready to retire, but she's not. How do you counsel such couples?
I mean,
Samit, yes.
to each one their own. I mean, you enjoy your retirement later work. I mean, it's not a rule that everybody needs to take a retirement. Forget early retirement. If you're enjoying the work and you are able to create that balance, then you do what you want to do, later do what she wants to do. It's not like you have to be working together and retired together. That's too much to ask or expect from your spouse.
My wife
Could be the other way around, by the way, as well. So
my wife has not had a job in a number of years because of the kid. But recently, after I've been spending more time at home, she's decided enough is enough. And she spends Monday to Friday mornings at a home for the aged doing their accounts as a volunteer. She gets joy out of it. No money. But it also keeps me out of her hair.
that's true. That is a very valid situation that happens in a lot of houses. So be careful when what you ask for.
Yes, we can take one more last question. If we get time, we'll get back to you.
Hello, my name is Anant. I would like to know what is the mortality age for the normal male and female? Normal healthy male and female. What is the mortality age as per data?
Vishal, do you want to take this?
Yeah. So there are so many assumptions in what you said. First, you use the word normal male. I'm trying to understand what that means, right? Then I'm trying to think about all the stuff. So I think we need to look at this very differently. I think the data is very nuanced because the fact of the matter is that life expectancy at the age of 0 is different from the life expectancy at the age of 40, is different from the life expectancy at the age of 50. And therefore, I think there's no way for you to be able to model that well from a number perspective. I think the bigger thing that anyone who's trying to find that number or the range of numbers has to think about is he or she going to be comfortable at some point when they will start eating into principle. I think that's what we found is the inflection point that creates a problem. As long as your money is going up, Naveen mentioned his portfolio has doubled in 10 years, right? Great, because money's gone up, right? In any retirement, as you get older, at some point you will see the curve starting to go down. And that's when we see all the panic happens. And I suspect that actually life expectancy goes down by 5 years just during that period. Because people can't handle the fact that they're now eating into principle. And I think that's the thing that we need to be really careful about. I'm sorry I couldn't give you a specific number on that. But I think it's just the reality that there is no one number as far as life expectancy as well, which will work across for everyone in the audience.
Just like to add here finally that just try to take 5 years extra of what you think it will be, because you cannot plan your retirement corpus with a certain age in mind. In case if you live longer, you cannot be on the streets that time. So it's always better to err on the side of caution.
Medical advancements are such that it will definitely be more, longevity will be more with times to come. So, in fact, there are some studies globally, not in India, which talk about it will reach its peak at around 110 to 120 and then it will stay there. Right? So, over a period of time. But yeah, it will only increase, not decrease.